So how do you invest in startups? Well, in this video, I'm going to share with you 7 of the most important questions that you must ask yourself before you invest. And by the time we are done, you're going to be able to step into the world of angel investing with confidence. Look, I get questions all the time from everyday investors asking how they can become an angel investor themselves. And I'm going to break it all down for you right now. Question number 1, what is a startup? Why should you invest in startups? How do you make money investing in startups? Best, worst case scenarios? How much money do you need to invest? What percentage of a portfolio should be in a startup? And where in the world do you find these different startups? Now, if you're new to this world, I hope you find this video extremely helpful. Also, I want to make sure you stick around to the end because I have a free bonus that I'd love to give to you. So let's dive into the 7 most important questions that you have to ask. Question number 1, what is a startup? Now, a startup is a company usually in its earliest stages. You know, when we watch Shark Tank and we see a startup enter into the tank, that is considered a startup. Now, a lot of this is determined around the revenue, the growth, how long they've been around to still categorize them as a startup. Now, most startups who want to grow other than bootstrapping, meaning they're just using their own cash to grow slowly along the way, they need to raise capital, right? And these are the startups that I'm talking about today. All right, question number 2, why should you invest in startups? Investing in startups, I believe, is a great way to diversify your portfolio. It's also a way for you to be able to support kind of these small businesses or initiatives or movements that you actually believe in. But let's be honest, there is a possibility for huge returns. You've heard all the stories, right? If the company gains traction or they sell to a bigger player out there like a tech company, or they go IPO, well, that's where the big money comes from. We're going to talk about that just in a second, but that is why people invest in startups. All right, question number 3, how do you make money? This is a great question, right? This can be confusing for new startup investors, but really, there are a handful of ways that you can actually see a return on your money. Typically, the one that is most likely to happen is what's called an exit. People will call it M&A, mergers and acquisitions. Now, a company will grow to a certain size and catch the attention of someone with very deep pockets. Maybe it's a private equity firm. Maybe it's a big player like Amazon or Microsoft or some other big player in their space that says, hey, I want to write you a big check and I want to buy you. Now, on average, the typical exit time frame, people go, I want to invest and I want to see my money tomorrow. Well, that's not how this works. Typically, an exit is about 7 years or so, depending on the industry and sector. So one way that an investor makes their money back is the company will exit, get a big check, and then you will then get a return for what you invested in early on in the company. Now, there's also an IPO, initial public offering. Now, it's a much harder route for a company to go public, right? On the NASDAQ or the New York Stock Exchange. There's a lot of hurdles and a lot of things they have to do to kind of get to that place. So an IPO is typically a little less likely to happen, but if it does, it's a great way for you. If you bought in shares at 25 cents a share, but they go public at $20 a share, well, that is a very good day for you as an early investor. And one other way that you can return your capital, one of the typical ways is through dividends. Sometimes startups will say, hey, look, we don't necessarily plan to exit. We don't really plan to IPO, but hey, look, we understand you took a risk and you gave us some money in the early days. We are going to pay out a dividend, and then they just keep paying along the way. So those are kind of 3 ways that you can see your money come back to you. Question number 4, when looking at a startup, you have to ask this question: what's the best case scenario and what is the worst case scenario? Let's start with the best case. All right, you've invested in a company, they're starting to scale and they're growing, and someone comes to buy them and bring them into their larger organization. Now, depending on the valuation that you invested in, or maybe some dilution of shares, this will determine the value of your stock once that company is purchased. So with that said, the best case scenario is what you see is a large potential return. Now, we hear crazy stories like Dropbox investors or Airbnb investors making like millions of % return from their early investing shares. Now, that would be amazing if that happened. Let's all be honest, right? But I want to encourage you, as any new investor who understands this is a long game. have to be patient, and we have to set reasonable expectations. One of the things I tell people all the time, those in my membership, those who are looking to understand the space, is look for companies that you think potentially could do a 5 to 10x return on your initial investment. Now, if anything happens beyond that, if it goes to 20x or 100x or 1000x return, well, that's just gravy on top. Anything over that is a bonus. All right, now let's talk about worst case scenario. Now, there's no way to sugarcoat this, all right? I'm going to always try and do what I can to be as honest as possible. Look, the real worst case scenario is that the company just doesn't make it and it ultimately loses all your money. Now, this is a very real thing. And early stage companies and investing in them, it is risky. So when you invest, you step into this world and you diversify your portfolio in this way. Look, you want to do a toe dip, learn along the way, and you've got to be prepared, right? That maybe potentially this startup won't make it and you will not see a return on your capital. Just something you have to think about. So definitely one of those questions you have to ask. What is the worst case scenario? And are you okay with that becoming a reality? All right, question number 5. How much money do you need to invest? Well, this really comes down to your personal decision, right? Only you know your limits and what you feel comfortable investing. Now, some startups will open their doors for as little as $100 per investment opportunity, which is pretty cool. But I got to be honest with you. Maybe $100 here and there is kind of to learn the space, but that's not really ever going to give you the big returns on the backside, right? I think it's a good way to get started, right? But one of the things you have to know is that eventually, if you make this a strategy and you start to lean in, you want to see even if we say a 5x return, right? Or a 10x return. If you put $100 into a company and they exit at 10x valuation, which is pretty good, you're going to get $1,000 back. Not bad, right? But if you would have invested $1,000 into a startup and they 10x, well, you get close to around a $10,000 check, which is much better. But again, this really comes down to your personal preference. And also sometimes it comes down to the limits of what you're actually able to invest per some of the SEC guidelines, the Security and Exchange Commission. So it's all about what you feel comfortable with and what works for your personal portfolio. Question number 6. Which percentage of my portfolio should I invest in startups? Now, again, I'm going to keep saying this. This comes down to a personal question, right? We're going to go back to the idea that investing in startups is risky. I would encourage everyone to maybe dip their toes in the water instead of jumping all the way in the deep end. One thing that people often say, or one thing you can consider, is maybe allocating 5 or 10% max of your portfolio into this space because again, it is risky, but even for new investors, you could even be more cautious and start slower than that. Question number 7, where do I find these startups to invest in? Well, there are a number of funding portals and platforms out there, but some of the main sites at the time of this recording are companies like WeFunder, Republic, Equifund, Start Engine, Net Capital. Now, each of these portals are very similar, but have different theses on what kind of startups they will allow to raise on their site. And one of the things I would consider if I was you is just go check them all out. Go look at all of them. We'll drop the links so you guys can go check them out in the descriptions and look at the different investment opportunities. Ask the founders questions and really get a feel for the space or the sector that they're in so that you can gain confidence before you jump into your very first startup. Now, before we close out here, I hope this was helpful for you to get a high-level overview of these 7 questions that are so important. Now, we've actually put these 7 questions as a quick cheat sheet in the comments below. So all you have to do is screenshot these questions, and then you'll be able to use those as you go do your due diligence and do your homework. Also, hey, if you haven't had the opportunity yet, subscribe to the channel so you don't miss anything when we're dropping information right here on the Crwd about this wild world of equity crowdfunding. And also, if you want to see the mission of me trying to be the very first everyday investor like you and me, I'm bringing all of us to Shark Tank as the very first guest judge in the history of the show. And I'm going to tell you how I'm doing all of it right here. So check it out. We'll catch you next time on the Crwd.